Does it? Let's bring in the team. SocGen, Subhadra Rajappa, Colin Martin of Charles Schwab and Jim Bianco of Bianco Research. Let's just start with your reaction to the payrolls report out several hours ago. Subhadra, first to you, please.
I think the number was disappointing by any measure, right? Especially if you compare it to what we got back in July. You got a weak headline number. You got, jobs, especially with, the unemployment rate ticked down, but the participation rate stayed unchanged. So even though we've seen, people starting to come back into the workforce, it's not as fast as the Fed would like. So from here on, every employment number is going to be very, very important for the Fed to decide if they're going to be tapering asset purchases at the November or December meeting.
Jim Bianco, your take, sir.
Yeah, I think that this number actually might have showed us that the July number of over 1 million jobs was the outlier and not this one, because all the data that we've gotten in the last month has been disappointing. The surprise indexes have turned solidly negative. The GDP trackers have been downgraded quite a bit, and yet we got another disappointing number. And if I can look ahead a little bit, September's number might not be any better. When we had Hurricane Katrina and when we had Hurricane Harvey in September of 2005, September 2017, we reported negative payroll numbers those months as well, too. So it really might just come down to Fed policy being how fast the power comes back on in New Orleans.
Oh, Jim, you think that maybe the Fed might miss a window here to make this decision? Is that what you're calling for?
Yeah, I'm afraid that they might have. They're going to have a disappointing number now. If the power doesn't come back on in New Orleans, they could have a number near zero next month if you base it on what we've seen with previous hurricane numbers. Now, if the power comes back on before the 13th, then we won't have that problem. And the governor said it might be weeks before the power comes back on.
Colin Martin, I'd love your take on what the goal of the Federal Reserve right now for the chairman and others on the Fed as well, Jim, is to de-link any conversation right now that you and we are having on tapering from any guidance on interest rates. Do you think the data as it stands, Jim, actually gives them some space, some reason, some justification for doing that?
No, they're going to have a hard time doing that because I think the markets are really tied into the whole idea of accommodation has been helping markets. It's been helping to suppress interest rates, that if they want to try and say tapering is not tightening, that is true. That is not a raise of rates, but a reduction in the amount of bond purchases can and will affect interest rates, and they're going to have a hard time trying to separate that from the larger issue. Yes, they're not raising the funds rate, but you stop buying bonds, you might see interest rates start drifting higher in this environment.
So your bias, Subhadra, just to be clear, is that a flattener or a steepener? If we're talking about faster interest rate hikes, it could be something different.
I think initially it could be the tapering itself could lead to perhaps a sell-off led by the belly, and eventually it's going to be a flattener as the market starts to price in a much faster pace of rate hikes. So a steepener first and then a flattener.
Jim Bianco, does this conversation sound somewhat foreign to you if you think the Federal Reserve could get trapped exactly where they are?
No, it doesn't. I mean, there's a lot of caveats. Unfortunately, Chairman Powell, gave his speech at Jackson Hole right before this disappointing number, and now we're going to have a lot of confusion in the data as we move forward from here. So it doesn't have to be a foreign conversation in that respect, but I do think what Subhadra was saying a minute ago, if you look at the dots, just to spin it a little differently, in 2023, you still have 5 members of the Fed that said they won't be raising rates at all by 2023, and 5 members of the Fed that say that they're going to raise it at least 4 times. There's no agreement in that room right now as to what they should be doing next. And you see this with Chairman Powell. He's been criticized a lot for not being very clear in the statements that he's been made about where the Federal Reserve is. And maybe he's just telling us what they do in the room is that there is no agreement. This kind of data where you get this weakness and maybe some more weakness is just going to further divide that drift within the Fed. We have to remember is they're not in agreement right now, and I don't think that today's report or any other weakness that we've seen is going to help them come to agreement about what to do next.
Jim, it's such a good point. We need to build on it. Jim Bianco is going to stick with us. Subhadra, it's this really strange dynamic right now where we can't settle this debate. At home, domestically, we can have a conversation about a hot economy and high inflation. Abroad, China's slowing. The data does not look good. The international story, with China in mind specifically, is very different. How do you put all that together at the moment?
So, yes, I mean, I think the slowdown in China is quite meaningful. You're starting to see mobility rates decline. They have a zero-tolerance policy for COVID. They're clamping down on the regulatory side, on tech companies. So it's definitely feeding through. You're also seeing higher shipping costs for shipping from China to the West Coast. So broadly speaking, the impact on the U.S. is not just on the slowdown in growth in China and emerging markets, but also things like shipping costs that are going to add to the inflationary pressures that you're seeing in the U.S. So this time around, EM is not going to be the tailwind that people would typically expect to be for U.S. growth. So this is going to be somewhat of a drag, if you will, on U.S. growth, as well as contribute to inflation in the U.S.
Jim, I bring this up because I wanted to build on your comments previously on the programme. Just 10 minutes ago, you were talking about how divided this Federal Reserve was, the difficulty that the chairman had reflecting a consensus that probably doesn't exist because it's so hard to put together. And I'm trying to get my hands around how finely balanced the outlook is right now, not just for the U.S. economy, but for the global economy as well. What would your take be on that right now, Jim?
Yeah, the global economy is really struggling as well, too. In addition, if you expand it beyond China, look at Japan, COVID cases have been rising quite a bit in Japan. Maybe that was Olympics-driven. 40% of Toyota's auto production has been shut in because of COVID. The rest of Asia has started to see a drop in the COVID cases, which might hope for a reopening of the supply chain. But there's a lot of it that has been shut down right now. And so when we've talked about throughout the spring and summer about the problems with the supply chain, the wording was it was temporary, it was going to get fixed. We used the transitory word there, too. Here we are now in September, and it's not any better than it was 3 or 4 months ago. So and it might in some measures be worse. So we've got a ways to go before we are looking at what we would expect to be a normal supply chain.
We are not where we thought we would be, and it looks like we might be. We're always thinking, Jim, about what's going to dent risk appetite. We know from experience that even if the Fed tapers, reduces QE, ends QE, markets can do OK. We know with experience that through tightening cycles, markets can do OK, in fact, better than OK, historically speaking. What do you think right now is on the horizon, Jim, that you do think could damage risk appetite? And I want to get away, just briefly, away from a conversation about the Fed going from 120 to 100 maybe to 90, 80, maybe down to 50. What difference does it make? Jim, what's on the horizon for you?
Yeah, the risk appetite has really been driven by flows. You know, almost every day, every hour, investors are putting money into the markets. And where are they putting the money in the markets? They're putting money in the index funds is pretty much 100% of where the flows are going to go. Anything that would change investor appetite for continuing to put money into the market, maybe it's a taper, maybe it's a revising of inflation expectations going to something more persistent than transitory. Maybe it is more problems with the with COVID or Delta or something that we haven't foreseen. But right now, I think really at the crux of what markets are is every second money keeps coming to this market. It keeps getting dumped into index funds, and it just keeps going up. And until that dynamic changes, I wouldn't expect the markets to change.
Jim Bianco, looking ahead, let's get to the final round, the rapid-fire round with all three of you, please. 3 quick questions, 3 quick answers, if we can. Your 10-year yield right now is up 4 basis points to about 132, call it 133. What first, 1% or 2%? What first, 1% or 2% on a 10-year yield? Subhadra.
That's a tough one. I'm going to say 1%.
Jim?
I agree it's a tough one, but I'll go with 2%.
Colin?
2%.
I missed that, Colin. Go again?
2%.
2%. Next question. Taper announcement, September, December or November? September, December or November? Subhadra?
December.
Colin?
I'll go with November.
Jim?
December.
And finally, first rate hike, 22, 23 or beyond? Jim?
I'll go late 22.
Colin?
2023.
And finally, Subhadra?
Probably early 23.
Interesting. You all had to think about those. I think that indicates something. It's taken a lot of thought still. Subhadra Japa, Colin Martin and Jim Bianco. To the three of you, thank you. Enjoy the long weekend. And to you at home, the same applies to you stateside. From New York City, this was Bloomberg Real Yield. This is Bloomberg TV.